Good morning, friends. Welcome to this webinar on effective retirement planning. Friends, we are delighted to have you with us today and appreciate your efforts and interest to take out your time on a Saturday morning to attend this event. Let me guarantee by the end of this webinar, you will have reasonable clarity and insights about the concept of retirement planning. Friends, my journey of financial planning started way back in 2010. Where I obtained my CFP certification. During that time, I realized that it's not the products that investors are looking at, it is the solutions. And most of the times, when we were dealing with corporate executives, we've noticed that not many are planning their retirement effectively. So that's when we've actually got into a series of corporate educative sessions, and then over the years, we've actually helped hundreds of investors plan their retirement under the financial planning. Right? So generally, even today, when we look at some of our clients' portfolios, so they have a bunch of insurance schemes, too many mutual fund schemes, and then too many stocks. Most often, we notice that the portfolios are not really aligned with the interest of the investors. So in most of the cases, we also notice that the corporate executives are unprepared for the retirements. Right? We are here to handhold many of you in case if you seek guidance at the end of the session. Friends, during the next 1 hour, I will make an attempt to address these issues, starting from why retirement planning, what is the right time to start planning for retirement, how much do you need to retire comfortably, are you ready for early retirement with live cases and examples, what are the common mistakes that people do during retirement or even otherwise? How to choose right investment product and dilemmas faced by investor. I think this is a reasonable package that we can cover in the next 1 hour time. So before we get into the subject of retirement planning, a bit about the general financial planning. I request each one of you to just look at this screen and do a health checkup, financial health checkup for yourself. Starting from, are you prepared to manage your finances without the salary coming in for the next 6-month period? Are you prepared to deal with any emergency which involves a financial outgo? Do you have a plan to achieve all your financial goals, and are you acting on these plans? Do you know how to choose right investment products for every financial plan? Do you know how much do you need to retire comfortably? Do you have sufficient life cover? And do you have sufficient healthcare policies? Friends, in life, there are some unprepared, unexpected situations that can crop up, right? I'd like to highlight some of them here. So we all understand inflation, right? So, but when we retire, after working for about 30-35 year period, there's a long period of retirement, at least spanning for about 25 to 30 year period. So the impact of inflation can be huge. So we'll look at those numbers subsequently. But one is impact of inflation over a long period of retirement of 25-30 year period. And because life expectancies have gone up generally, so we also need to prepare our finances for a long retirement. There are few cases which I have actually come across while dealing with my clients, that in some cases, the children take probably more than normal time in terms of settling their careers. So of course, as parents, we just need to still take care of them. Likewise, the aging parents, right? So I think there are few cases, where we noticed that probably until 30 years odd, so the kids are yet to settle, and then as parents, we just need to take care of them. Of course, there are medical emergencies, we need to deal with it. There are marital breakdowns and divorce, and then death of a main income earner. Unless someone plans their finances carefully, factor in these kind of instances, creates emergency funds, right? It's not easy to just sail through these kind of unexpected situations. Let's also look at what financial planning does and what it is not. So what is the objective of financial planning? Objective is definitely not to maximize returns. So when we meet investors, when the investor asks us, how much of return can I expect? There are multiple instruments that carry multiple risk and return profile. So the objective of a financial planner is to understand the requirement of the investor and then talk about what is the most suitable instrument that can help the investor achieve the financial objective. In some cases, safety can be an objective. In some cases, moderate returns can be an objective. In some cases, high returns can be an objective. So by and large, objective of financial planning is not to maximize returns, but to probably optimize returns, right? Improve the chance of achieving your financial goals. Say, for example, let me take an example. If somebody is planning a daughter's education or daughter's wedding, maybe which is coming up in the next 1 year period, and they ask us, okay, where they can put this money. So they've already created the fund, maybe 50 lakh, whatever the amount, and where we can. My simple advice is that event is coming up, maybe after 1 year period. So don't take risk. Idea of this money is not to maximize returns. Idea is to make it available at the event. It can be simply be parked in a liquid fund or an FD, fixed deposit. So we don't have to reinvent and then experiment about maximizing returns in every case. There are cases, okay, where making the fund available for the event effortlessly without any issue, that is objective, right? And objective of financial planning also is to help you make informed decisions like early retirement. We've actually advised host of investors. In some cases, we've actually advised them not to go ahead with early retirement, looking at the whole financial health. And in some cases, after our review, people have actually gone for early retirement. Believe me, even some of the doctors that we talk to, they're also interested in retirement planning. I am from family of doctors, right? So the doctors, technically, there is no concept of retirement. But believe me, in this generation, people are actually opting for early retirement, right? So help you prioritize your financial goals, allows you to focus. I think once the finances part is taken care, I think it's possible for you to focus on your passions, hobbies, once these goals are achieved, right? So we all talk about inflation. We all understand inflation. So there's a lot of talk about inflation. Even my 14-year-old son wants a higher pocket money because of inflation. But friends, do we actually understand inflation over a long period, what it can do? So let's understand, maybe some of you who's at 40 has a current requirement of 1 lakh rupees per month. I mean, maybe in some cases it can be higher. So let's understand, by the time you are 50, so the value of the same 1 lakh, right, is actually dropping to 55,000. That means you require about 1,79,000 rupees to maintain the same standard of living that you're doing. So today we are having two problems. One is inflation. Second one is even lifestyle. So assuming that the lifestyle remains the same, which most of the cases it's not. Most of the cases, with the passage of time, our lifestyles are also going up, our requirements are also going up. Even assuming the lifestyle is constant, at 50, the value of money is actually dropped to 55,000. Thereby, the requirement, even at a 6% inflation, has gone up to almost 1,80,000 rupees, right? So let us move down, because retirement is about long periods. By the time you turn 60, that means, okay, you're at 40. By the time you achieve the retirement age, the same 1 lakh rupees to maintain the same standard of living, your requirement is actually going up to 3,20,000 rupees, because the value of money is actually dropped to 31,000. So to maintain the same standard of living, you require, now you retire at 60, then you need to live life beyond for another 20-25 year period, right? Because life expectancy is also going up. So here we've captured the data until 80. That means in the last phases of your life, maybe when you touch 80, right, the value of money has actually dropped to 9,700. You require almost 10 times the money to maintain the same standard of living. So over a long period, it is very difficult to estimate unless you see the numbers, to estimate what you actually require, because this is the requirement that is actually going up for the same standard of living, right? So inflation is not going to subside. Of course, it can reduce, right? But lifestyles are going to go up. So it requires a very careful planning. And of course, okay, the FD or any fixed income will not be able to handle this kind of requirement. So let's then talk about lifestyle. See, I remember the previous generation, my father, he was a doctor. When he was young, he bought Java. He was riding the motorcycle. By the time he touched 45, I think he used it for a pretty long period. He bought a Vespa scooter. And then towards his retirement, he bought the Santro, Hyundai Santro. right? So more or less, I remember his lifestyle has not changed, right? But look at us. I think every 3 years we have the urge to change the phone. Not just us, maybe the kids, the children, the teenage, so the spouses. So we all need to change better. I think the branded, we start migrating to higher and higher brands. So even the automobiles, I think we want to probably buy best of the automobiles, live in luxurious houses, right? There is also peer pressure. I used to drive a Mitsubishi Sedia. I drove it for 17-year period without having any problem. My kids love it. My wife doesn't have a problem, but my neighbors don't like it, right? So they always push me, when are you buying the new vehicle? So eventually I bought it, but of course, okay, these are the problems with lifestyle when you live in communities which all of us live, right? So just not inflation, there is a problem with lifestyle, and also for the current generation, there is a problem with investment discipline. So the inflation, we've already discussed that for a period of time. So what are the most common financial goals? Because this event is specifically tailored towards salaried class, us employees, right? So what are the most common things? Okay, when we start earning reasonably, initially, all of us want to start with buying a car. Then eventually when we get married, we want to buy a house. Then we require some emergency funding. Eventually the amount is also needed for education of the children. Then we don't want to postpone holidays. So we also want to holiday. So while doing all these things, retirement always takes a backseat. And it takes such a backseat that, okay, but because everything is going on EMIs and we are fully leveraged, right? So retirement is always the last priority. Unless somebody is aware of it, consciously develops it, it will be difficult. Once retirement is taken care, then it's the wealth creation that moves. I think what is that, okay, we can leave behind for the next generation. So this is the reality that, okay, retirement is always taking the backseat, right? So why retirement planning is essential? Friends, let me tell you, we all end up working for about 30-35 year period, right? So what is going to happen during 30-35 year period? Number one, at the end of the month, we all receive salaries, and then we are used to receiving the salaries by the end of the month promptly. And every year, because of the performance appraisals, whatever it is, we end up doing well. We also get increments, so which takes care of inflation, and then gradually the amount that we are going up, the amount, the requirement is actually funded by the increment in the salaries, increment in the ESOPs or bonuses, whatever it is. I think so everything is taken care. But there comes a day when we retire. That's an eventuality that we all need to face, right? Whatever we are used to it for 30-35 long year period, the receiving of the salary at the end of the month, that is going to stop, right? Then we all need to survive for the next 20-25 year period. So without the support of any salary, unless we prepare well, right? So we'll also look at the requirement numbers, retirement numbers. I'll give an example. So I can talk about a lot of case studies here. I have a neighbor who was a scientist in ISRO. About 15 years back, he left ISRO and then joined one of the large IT firm. Doing very well, reached the top of a vertical. His vertical was profitable, but unfortunately, the companies decided to wind up the vertical, and at 56, so he had to leave the job, right? So we are very close. I was working on his retirement plan, right? So he had sufficient funds to take care of it. Of course, okay, it's not that he's not unprepared, but 3 months into retirement, that he felt very uncomfortable not receiving the salary, which he is used to receiving it for 35-year period. Number one is that having sufficient amount that you can dip into it. Number two, ensuring that the cash flow happens effortlessly, right? So if you are used to receiving an income of maybe 2 lakh, 3 lakh, 5 lakh, whatever the amount, then it is very, very important that, okay, we have that stream of income flowing into our bank account effortlessly for the next 20-25 year period, and also moving in line with inflation. So that's what is required. Extended. So this is why retirement planning is very, very essential. So the inflation impact we spoke about. At times, okay, there can be higher healthcare costs. Okay, healthcare costs have really, really gone up. It is estimated that healthcare costs are actually going up at an inflation of 14%. Education is going up at 10% inflation. The regular inflation, of course, okay, we generally consider 6%. Probably now we can taper down to maybe 5%. Let me also tell you, while we are young, we can afford to make mistakes, and then we can recover from it, because we still get the salaries. I think the large population still lives on paycheck to paycheck, and they've never got the expertise in managing the lump sum amount. Most of the salaried class, and eventually towards the retirement happens when you receive the retirement benefits. Not many are trained to handle that balance in such a way that okay, they can create those kind of cash flows. Again, what are the right instruments to choose? Because there are too many advisors coming in, right? So which one to rely upon, whom to take advice from? So I think these are all the dilemmas that all of us face. So this is the retirement calculator. Depending on what is your current age, in the first column, first row, you can look at what's your current age and what is the age of your retirement. It can be 50, it can be 55, it can be 60. I see many of investors are opting for early retirement of late, and this is going to really help us understand whether somebody can actually opt for early retirement or not. So here, monthly expenses, it can be 2 lakh, it can be 1 lakh, it can be 5 lakh. What are the amount? Here we've taken the case of, and then we also need to plan what is the life expectancy depending on how long the parents lived, how long the grandparents lived, and depending on our physical health conditions. So usually, if no other complications are there, generally we advise people to plan at least for 85-year period. See what is happening. Let's take the first case. So if you are in 35, right, you are expected to retire at 60, then you have a 25 long years to retire. Right? Believe me, retirement calculations are scary at this point of time. So don't get shocked with the numbers that are going to appear here. Right? So you still have 25-year period. The good news is that you have 25-year period to plan for it. The bad news is that in 25-year period, the inflation is going to go up so much that we have seen the numbers before, right? So the requirement is also going to go up very, very high. So what we are saying is that in the next 25-year period at 6% inflation, so the 2 lakh requirement currently today will require to maintain the same lifestyle at 8,58,000. That means okay, the day of your retirement, the month that you retire, your monthly expenditure is actually going up to 8,58,000. The same case, okay, if you are at 45, the time that you retire, the 2 lakhs is actually because the time to retire is only 15 years from now. So this is a big difference between 25 years and 15 years. Here, see, the requirement is almost half a year. So assuming that you are at 45, so the same 2 lakh, the time of your retirement, the first month, your requirement is actually 4,79,000 rupees. In case if you are at 50, you have 10 years to retire, and then the requirement is changing to 3,58,000. This is the first month, first year cash flow that you require. First month and first year cash flow that is required. Now let us move to what is the retirement fund that you require to fund, because it's not just the standard 8,58,000, because every year that amount has to again go up by about 5 to 6%. So the first case, if you are at 35, still have 25 years to retire, right? Your monthly expenditure is 2 lakh, and your life expectancy is about 85. Your total retirement corpus that is required is about 20 crore, right? 20 crore. But good news is that you have 25 years to get to this 20 crore, right? Compounding, all of you must have heard about compounding. Compounding works magics. We will also look at those numbers. And today, if you are able to commit, about 1 crore 20 lakh rupees, then about 25-year period at 12% growth rate, if the markets are moving up even at 12% growth rate, that will become 20 crore. So the discipline is required in terms of choosing the right investment products that will actually compound. So there is no error for, there is no margin for errors here, because the money has to compound. And you need to effectively invest. And then if you are doing an SIP, assuming that you don't have the monthly lump sum amount to invest, towards retirement, you need to make a monthly investment of 1,09,000 rupees from here on, right, over the next 25 years, so that you will end up with a corpus of 20 crore, 20.54 crore, right? So that's what we'll end up. Now let us look at the same numbers for someone who's at 50, and if your monthly amount is 2 lakh rupees. So don't get worried about this. I think we will be working a tailor-made. This is not a solution for everyone. Every case is a unique case. Every investor requirements are unique. So we will be happy to just work with you individually and then work out a plan that is more suitable. Don't get worried too much about in case if the corpus is not done. So we will be happy to just sit with you and optimize on how to properly invest your retirement amount. So the same thing, okay, if you're at 50, 10 years to retire, 2 lakh is becoming 3,58,000, right? The monthly cash flow on the first day of retirement. So the retirement fund that is required, right, in 10 years from now is about 8.57 crore. And today you need to have at least 2 crores 76 lakh to fund for your retirement, because in about 10 year, 12% growth rate, 2.76 crore will become 8.57 crore. So I hope all of you are clear. What we can also do is, towards the end, if you have time, we can take up some of the live cases and then actually discuss these numbers. So we spoke about why retirement plan is essential, right, with some of the examples. So during my experience, the last 15 years, I've met somebody who's in the 40s, completely ready to retire. I've also met people who are retired but not ready completely, right? So if you have time, we can actually optimize your resources and then plan the retirement properly. So let's also look at, there are some of the surveys which are done on the retirement planning. So Economic Times has done one survey last year. So let's look at what are the results of this survey. When they interviewed people who are less than 40 years, none of them consider retirement as, most of them, let me put it this way, most of them don't consider retirement as part of the top 3 priorities. What would be the priority for somebody who's at 40-year-old? Children education, maybe a house, or anything, maybe a holiday, that is also required. So but most of them are not considered at 40 or less than 40 retirement to be one of the top 3 priorities. So let's also we've also looked at, I think there are 23% of the respondents, they have not even thought about even saving for retirement, right? Let's move to somebody who's crossed 50, right? 4 out of 5 of people who've crossed above the age of 50 feel that they should have started saving for retirement earlier. So until 40, you are not considering retirement as one of the top 3 priorities. You don't even think about planning for retirement. By the time you move to 50, you feel that, okay, whatever the saving that you've done or the time that is left for you to save enough is not sufficient. And then you always feel that, okay, you should have started this journey much before. And again, 4 out of 5 respondents, they fear that savings will not last through the retirement period. Friends, I think most of you must have visited United States. Every time I visit, I notice one thing. So if you visit some of the supermarkets, Walmart, Target, some of the supermarkets, most of the cash counters are handled by very old people, right? During my last visit, I've seen 2 Punjabi couple who are handling the cash counters at Walmart. They should be in their 70, 75. Both of them must have crossed 75. And the way they're operating it looked like, okay, they have not been doing it for a long time. So they've just started it. They're struggling. They're fumbling, right? Handling it. Felt sorry, but generally notice a lot of people who are maybe 75 plus, 80 plus. You can notice that, okay, that they're handling the cash counters. I wish, okay, that that's not out of compulsion, but I'm afraid, okay, most of the cases it appears so. Now that we understand why retirement plan, so most of us, I believe, are convinced that, okay, we need to start taking retirement plan seriously. Now there are 2 phases of retirement. Phase 1 is accumulation phase. Before, if you are 40, 50, then you are working towards retirement, how to accumulate the corpus. And phase 2 is the disbursement. Okay, the corpus has to help you generate those cash flows. So what is number 1 that is required? So this is like a filter. What are the attributes of a retirement investment? These are the post-retirement. Once you retire, once you have the corpus, so the investment that you make for the retirement should go through these filters. There are 6 filters that it has to go through. So number 1, you require cash flow. Number 2, because you are working on a pretty long period, in about 20-year period, your requirement is tripling. No FD, because long term we all expect FD rates to drop further, debt interest rates to drop further. So there is an element of risk that you need to carry, an element of equity to be able to beat inflation. It has to be liquid. You cannot lock in. You cannot invest into too many lock-in funds where you cannot access funds. Number 3, investment have to be tax efficient. They have to carry right balance of risk and return. And more importantly, simple and easy to manage. Let me start with the last one. When we are planning for retirement, when we are planning somebody's retirement, possible that I might outlive their retirement will go beyond my retirement. If I am currently 54, if I'm working with someone who's in the 40 or 50, their retirement will be beyond. I think probably I'm going to retire in the next 6-year period. They're going to. So if I'm giving someone a plan, the plan cannot be too complex for the person to be able to manage. It has to be so simple, effortless to manage, that once we trigger these cash flows, it has to be effortless, right? So number one, it has to be easy and simple. Let's put some of the investments into this frame. So first one, let us start with FD. Does it generate cash flows? Perhaps okay, it can pay you interest. Does it beat inflation? No, FDs cannot beat inflation. Liquidity, partially, you will be able to liquidate. Tax efficiency, no. FDs cannot give you tax efficiency because they are being charged with the highest tax bracket. Of course, they are low risk, simple to easy manage, no problem. So let us look at equity stocks. So some of you should be managing equity portfolios. Let's look at. So do they generate cash flows? Of course, you make dividends in some of the stocks, but they may not be even, right? If you require a 2 lakh cash flows, dividends may not be exactly equal, and then you may not get a monthly cash flow, right? Does it beat inflation? If a well-managed portfolio is there, you can actually beat inflation. Liquidity, yes, most of it is liquid. Tax efficiency, if you are not getting into F&O, then pure equity cash buying is tax efficient. Are they risky? Depending on how you manage it, they can be risky. Simple to easy manage, may not be. So as you, there are many of you who could be managing equity portfolios, but there comes a point, or maybe at 65, 70, 75, there you feel that okay, you cannot continue to manage it, right? So let's look at mutual funds. Does the mutual fund fit into this? Right. Within that, we can also look at hybrid mutual funds. Right. What are hybrid mutual funds? They have an element of debt equity, right? So they have a right element of debt and equity, and we also have something like multi-asset funds. They have debt equity and even commodities also, gold and silver. They can also have. So let's put them to this test. Mutual fund. See, there are dividend payout option. There is growth option. Dividends are not again tax efficient. So we offer growth option whenever we invest into mutual fund. So there's something like most of you must have familiar with SWP, systematic withdrawal plan. Believe me, for retirement, systematic withdrawal plan is the most efficient way to create this cash flows on the post-retirement. What should be using? Should you be using the equity mutual funds or a hybrid or multi-asset? It all depends on case to case, depending on your risk appetite, depending on how much other cushions that you got. So that's the thing. But by and large, we are comfortable with these two categories: hybrid, multi-asset. These are the two categories that we can recommend. So let us put these two categories per test. Do they generate cash flows? SWP, yes. So when we trigger an SWP, say for example, a 2 lakh cash flow can be managed from 4 funds. We don't like to have too many funds. Each fund we can create an SWP of 50,000 rupees. So every month on a defined date, your bank account will be credited with an X amount of cash flow. So 2 lakh, in case if it is 2 lakh, 2 lakh. Does it beat inflation? Yes. Hybrid mutual funds also tend to give historically anywhere between 10 to 12% kind of return, right? Historically, but going forward also maybe 8 to 10% kind of return is possible, comfortable. So do they beat inflation? Yes. Historically they have beaten inflation. It is possible that going forward also they can beat inflation. Let us look at liquidity. Yes. At a 2 days notice, you will be able to liquidate most of the mutual funds. Are they tax efficient? Yes, they are most tax efficient because beyond 1 year, they are getting taxed at 12.5%, right? Most tax efficient instrument. Do they carry right balance of risk and return? Because it's like having a component of equity, debt, and even multi-asset, other components, there is a right balance. And then you are not deciding the balance, you are actually putting that in the hands of a professional who's a fund manager who's been handling it. What is our job as an advisor or a distributor? Our job is to help you identify the right fund managers or right funds, right? Is it simple and easy to manage? Generally, mostly mutual funds don't require a shuffle unless there are extreme cases. In case if there is a fund manager who's been managing for a long time leaves and you doubt on the fund house's ability to replace a fund manager. So that's reason generally when we are going for retirement, we look at those fund houses which have the solid track record of continuing with the systems and processes. They have got the ability to replace fund managers effectively. So in all, we believe that hybrid mutual funds, multi-asset mutual funds are perfect case, right, to use as post-retirement investments. Now, is that sufficient? What about insurance plans? There are interesting pension plans and some of the traditional plans which we consider to be important to have. Why it is important to have? Because at any point of time, when we are talking about a 25-year period, even with hybrid multi-asset mutual fund, you will have 60% of your amount invested, 65% plus kind of amount invested, exposed to markets, because they invest anywhere between 65 to 70% into equity markets, right? So when we talk about 25-year long period, possible that you can face two extreme cases of market volatility, right? If you go back the past 25-year period, you will find an event like Lehman crisis or 2018 or the last one year crisis, which is not very big, but we've seen a major crash in 2008 plus in 2018 where mid and small caps have corrected. So it's going to be scary at times to have everything invested into market related instruments. So having some kind of stable instruments which can actually lock in your returns. The advantage with some of the pension plans and some of these traditional plans is that they help you lock in the interest rate, and then they are tax efficient also, right? So today I think the interest rates are long-term interest rates are available in the range of maybe 6 to 7%, right? But we all know the next 10 year, next 20 year, they are going to drop significantly. Now, if there is a plan which is going to help you freeze that interest rate and help you get that same interest rate for the next 20, 30, 40 year period, I think why not? So, and because they carry an element of guarantee, they carry an element of tax efficiency, and it's always good to have that combination as part of the retirement cash flow. What are the alternative sources that you can still plan? Some of you having maybe rental income coming in. It is also good source of having retirement cash flows. But the real estate property has to be such that it has to give you decent rental income. So that's a choice that you can do it. If the property is giving you a decent rental income, that's one more. It can take care of inflation, right? So that is one more way of looking at it. So we've looked at why retirement planning is essential. We've also looked at what are the right instruments that you can choose for retirement. Now coming back to pre-retirement. So you still have 10 years to retire. You still have maybe 15 years to retire. I think this is the period where you can actually take risk, because all of us have provident fund, pension, like PF, the amount which is actually completely dead, and all of us retire with significant amount. Then you can actually case to case, okay, we can sit with you and then explain to you. Then most of the cases, okay, you can actually allow the money to compound, so the equities can be a better class. And within that, there are instruments like mutual funds, there are PMSs, portfolio management services, AFs. So we will, in a short while, also discuss about what are the various options and then what you can do with them. Now I'm moving to the one more important topic. What are the dilemmas faced by investors? Now we know we spoke about retirement. Then coming back to pre-retirement, you can actually invest in direct stocks. You can also invest into mutual funds. You can also look at PMSs, real estate, right? So within mutual funds also, we've noticed that people actually invest a lot in sectoral mutual funds or even thematic mutual funds. So we will also deal with that now. Friends, let me tell you, I'll actually use Excel here. Give me a second. Let me discuss some live cases that I have come across in terms of compounding. About 4 years back, I met a gentleman in Delhi who's retired 5 years back. He's been managing a portfolio of about 5 crore. 5 crore portfolio, and then he's very happy. He's an ex-banker. He understands market, he tracks markets, he researches, then makes his own investments, right? So I asked him a few questions. He retired 5 years back, right? And 5 years back when he retired, he started with a portfolio 3.5 CR, which is today become 5 CR, right? He's very happy to tell me that he is spending all his retirement time and then created a profit of 1.5 CR in the last 5 year period. Then I've just made this working. I hope all of you can see this number. I've shown him this working, that at what rate your money is actually grown. So in about 5 year period, an investment of 3.5 crore has become 5 crore and money actually grew at 7% return. Then I told him, so on the day of retirement, had you put your money in the FlexiCap mutual funds? And during that period time, the past 5-year FlexiCap returns was about 15%. About 4 years back is what I'm talking about. Right? So then I told him, had you invested in a FlexiCap return funds on the day of retirement? So FlexiCap returns, as I said, have given 15% return. We are not talking about too much of the period remains 5-year period. And if he's put in the entire retirement corpus of 3.5, and we are not talking about best FlexiCap, we are not talking about a worst FlexiCap, we are talking about the average returns of FlexiCap as a category. So had he done that, he would be at that point of time sitting at 7 crore ka portfolio. Friends, let me tell you, I think this is what I noticed with almost every investor who's been managing the long-term portfolio of the direct equities, right? Most of them are, in my experience, compounding their money between 7 to 8%. So that leaves the question as to why so many people are not able to compound their money, and why for any long-term compounding, mutual funds are a PMS or AIF are a better option, because they are being managed by a professional. What I've noticed is that when you create, I'm sure most of you can also relate to this. When you create your own portfolio, generally it is observed that nobody likes to book loss. You buy 10 stocks, 7 stocks go up, 3 stocks come down, right? You are comfortable leaving those 2-3 stocks until they come back to your at least cost. Not every time all of them come back to the cost, right? So eventually what I've noticed, almost in every case, I think almost 30 to 40% of everybody's portfolio is with probably non-performing stocks. And believe me, with about 30%, 40% of the portfolio not performing, the compounding can never happen. So believe me, 95% of the people today are not able to compound because people are not booking loss, and people have 30-40% of the portfolios into probably not performing stocks or loss-making stocks. Thereby, you are comfortable doing this investment, any long-term investment, through mutual fund, because now we've already seen those numbers, right? If money has to grow, it has to grow systematically. For a long time, if the compounding is not happening, then you are actually not creating the corpus they actually require. So the case with mutual fund or a PMS fund manager, they cannot afford to sit with any large caps. So they are being tracked on a month-on-month basis as to how they are doing against the benchmark, right? Let me talk about the second case. So this is the case that I came across in Surat about a few months back in May when Operation Sindoor happened. I met a gentleman who's in his 40s. His father passed away about 13 years back, but handed him over a portfolio of 6.98 crore. So 13 years back, he handed a portfolio which has now become 18 CR. So he's also happy that he made a profit of, actually he's not done any changes to the father's portfolio because he doesn't understand. All that he's done is that he simply carried the portfolio, right? He just continued with the portfolio, and then he is happy that he made a profit of 11% in this case. So I've also done the working here. Then I explained to him that his money during the period has grown by approximately at 8%. It's across 7.5%, 7.6%. Right? So then also we looked at what is the FlexiCap returns during the same period. We noticed that FlexiCap actually grown by 13% during that period, FlexiCap average returns. Then I told him, had you on the day, because you never understood investing, your father understood it, and had you invested the corpus in the FlexiCap, which actually gave 13% return. So we are talking about 13-year period, and the amount invested is about 6.98 crore. So that would have become a hopping 34 CR, right? So I can go on with number of cases. I can talk about number of cases, and what is common is that people are not able to compound in line with the market. And what mutual funds do, good quality mutual funds in India, globally ETFs do better, but in India, thankfully, the active fund managers have been doing good. You can also have a component of your money into ETFs also, but because active fund managers are able to create a positive alpha for a long period, I think it's not a bad idea to even consider some of the active mutual funds. Now within mutual funds, what to choose? should you be choosing large cap, should you be choosing mid cap or small cap? So here the data. Before I come to sectors, I can talk about small cap, large caps. So in every year, so which is the index, small caps between mid caps and large caps, which have done the better, right? So the top one talks about the category which is done better, right? And you can notice that not every time, if small caps have done better last time, normal tendency that investors will chase returns and invest in something that is doing well, right? So next year, so if you look at small caps have actually fallen by 14%. Again, the following year, probably small caps have done reasonably okay, but mid caps are the champions. Then mid caps for the next 3 years, mid caps have done well, right? Small caps have not done so well. Then again, small caps have come in. Then if you can look at large caps, so there is no pattern if you look at it. So as a normal investor, what do you do rather than you deciding whether it should be a small cap, mid cap, or a large cap? You give money to some of the categories like flexi cap or even a focused, right? We will help you do that. So during the accumulation stage, right? So let us move to the sectors. Again, we see a lot of investors investing into a lot of sectors, a lot of NFOs. We come across investors who invested nearly 60 mutual fund schemes, right? There is no way you can beat the markets with 60 mutual fund schemes. Look at 2012, banking is something which is done very well. Then look at 2013, banking is the worst performer. If you look at banking has done negative return. Again, move to next year. If you avoided banking here, banking is again started performing next year. Then again move to the next year. BankX is again come to the bottom. At the same time, there is no pattern that you can always look at something which is at the bottom. So thereby, if you think you have the expertise and the skill to pick up the sectors and then rotate the sectors, I think it's not just the entry, exiting the sectors, because every sector can go out of style in about 1.5 year, 2 year period. So you need to be so agile that you are effectively moving between sectors, right? So if you're not probably trained to do that, or if you're not capable of doing that, the best way is again to go with diversified mutual funds. So we addressed the issue of whether you should go with direct stocks or mutual funds. My advice is simple. The last 10 years, managing on your own, if you are able to compound the money in line with the market or create a 2 to 3% alpha over market or over mutual fund, you should stick to investing in direct stocks. Or it's a better idea to actually go with mutual funds. Now, we've already seen whether you should be considering diversified mutual funds or sector. If you are trained, if you understand the markets, if you can actually move between sectors, then you can do that. But otherwise, okay, my advice to you is to stick to diversified mutual funds. Then comes to the decision between whether you should consider PMS versus mutual funds. So while mutual funds can be invested even for a small amount, portfolio management services, SEBI has mandated minimum size to be 50 lakh, right? If you got only 50 lakh to invest, don't choose a PMS, go with mutual funds. But if the size amount goes up, if the amount is going up, say for example, we are expecting India's nominal GDP to grow by 10% and India's corporate earnings to grow, long-term historically have grown the same line, but we expect next few years to corporate earnings to grow up by maybe 12 to 14%, right? So the diversified mutual funds indices generally reflect the performance of the corporate profitability. So indices, if they are expected to move between 12 to 14%, good quality mutual funds should give you about 15-16% return. If you are happy with 15% return, at which rate your money doubles every 5-year period, you don't have to step into PMS, right? So again, within mutual funds, how many mutual funds to have? We've seen portfolios in excess of 20 mutual funds, 30 mutual funds. In my view, ideally, I think 7 to 8 mutual fund schemes is good enough, good quality. We will be able to help you with that, right? So there are good quality PMSs. Again, PMSs in a good market, so can give you an alpha of about 5%. A well-managed PMS. There are every category. There are good investment, bad investment. If you choose a well-managed PMS, it has the potential to give you maybe 5% alpha over indices. There are a bunch of them who have done that consistently. So if you want that extra return of about 2 to 3% over mutual fund, then you can consider PMS as a portion. So always when we create portfolios, we always look at 60 to 70% into mutual fund, maybe 30-40% into PMS depending on the case. Real estate versus equity, all of us need to own a property. Then again, after a particular time, probably beyond 40-45, you need to create a balance between real estate and equities, because or rather liquid assets, right? So because real estate in a bad cycle, if you get caught, many of you can agree with me that it takes a really long time to get out of that, and it's really illiquid, right? So you need to create that balance of liquid and illiquid kind of assets, right? So coming back to lump sum and SIP, it's a case to case, it's a status of the market, right? So there are times, okay, markets have collapsed, which gives you an opportunity to put lump sum investment. You can do that. The times, okay, where markets are going up, okay, markets are not cheap, then SIPs. There are times, okay, you can use a combination of both, right? So if you find this exercise to be complex, we are willing to help you. How many funds to invest? I've already clarified that. About 7-8 mutual funds will do that. So let me again come back to the common mistakes that are committed that we notice. Number one, I've already said we don't see many people who are retiring with complete preparedness. Number one. Number two, we also people investing in funds, investing in products without completely understanding them. So somebody is advising them, somebody is confident. So there are times, okay, where investors ask me, you like the product, you are confident about it, they are taking a bet on me. I say no. So you are the person who's investing, you need to understand the risk, you better understand the risk, and you take a conscious call, right? So that's very, very important that, okay, rule is very simple. Don't understand an investment, don't get into it, right? Even Warren Buffett follows that. He never understood IT, he never got into it. But despite that, he made returns, right? So poor diversification, so either over or under diversification portfolio, we spoke about having too many mutual funds, too many stocks, or too little. In some cases, okay, some of it should be having stock options, not very diversified. So we've done that analysis between some of the famous stocks and holding them or diversified mutual fund portfolio. So we will be able to share that. Low liquidity. We spoke about real estate or any other investment. Concentration risk. This is a case of ESOPs. Either we found people investing too much into fixed income. I can talk about one of my, she's my classmate. She was my classmate. She's a college topper into finance. She got into training as a profession. But today when we met during the college reunion, she told me that all her investment are into fixed deposits, right? So because she never understood this side of it, never wanted to take any risk. She is not prepared to take any risk. So in that case, okay, completely money is lying in the fixed deposit, money is degrowing, right? Delayed start is one more thing that we can talk about it. Friends, this very, very important slide, I request you to pay attention to it. We spoke about retirement planning, we spoke about financial planning, right? So this is another approach. So in financial planning, what we are doing is we are trying to identify a goal. So then understanding how much you require, how much money that you require to accomplish that goal, and then how do you go about saving for that, right? This is another angle. This is more suitable for people in the business. But of course, okay, once some of you feel that you have achieved all your goals, and then finally you are managing it, how should an asset allocation be? How much money should be in debt? How much money should be in equity or even gold? Here I have not considered real estate. So that's a separate subject, right? How much money should be in even private equity, venture capital? Should you be investing into unlisted shares or not? So let me address this point. This is something that I've prepared with my expertise and experience over interacting with a lot of people. So then if you have a planned expenditure, now I'm addressing the first bucket, which is a low risk bucket. What is a low risk? Debt. You call it fixed deposit, you call it liquid mutual funds, debt mutual funds, corporate FD, all this come under bonds, all of it come under low risk. So if you've got any planned expenditure, what is a planned expenditure? Sending a daughter for foreign education. You know that, okay, that event is happening in the next 6 month time, or you're planning her wedding maybe in the 1 year time, or even 1.5 year time. You know that the event is going to happen, but you don't know when it's going to happen. So that's a planned expenditure that should always be in debt, right? There are cases, okay, somebody is going to ask me, now we are planning a daughter's wedding, next 1 year it can happen. So I have maybe this 50 lakhs set aside. Where shall I put this money? My advice is very simple. Leave it in liquid fund, leave it in fixed income, fixed deposit, wherever it is. Objective of this money, cannot be to maximize returns. Objective of this money is to make the funds available when the event occurs. No point in taking the risk. Second one, emergency fund. All of you are aware of emergency fund. So the rule is simple. If you are working, you need at least maybe 10 months ka expenditure or 6 months ka income as an emergency fund, right? So this is something, and even if you retire, you need to have an emergency fund at least 10 to 12 months ka expenditure. And why do you need to create an emergency fund? Because we are earlier discussed that significant portion of this cash flows should be created from diversified mutual funds. Let us imagine there is a bad year, like an event like maybe 2008 or 2018 or a COVID kind of event. Because of course the blessing in a COVID kind of event, the markets bounce back very fast, right? So, but when you are in the event, when you're in that kind of situation, then I think it's possible that we feel terrified, because portfolios would see an erosion of during the COVID time. Market portfolios have actually hit by 38%. Nifty has fallen by 38%, right? So 2008, I think it's fallen even higher. 2018, mid and small caps have fallen very badly. So it's possible that those kind of events can happen, and it is scary to, or probably not right, to continue this SWP when the markets have actually fallen very badly. So it is during that time, the emergency fund, in case if you are able to create that kind of corpus, you can start dipping into the emergency fund without actually withdrawing this SWP, without actually triggering this SWP. So I think planned expenditure, it has to be in debt. Any emergency fund has to be in debt. What is strategic allocation? Of course, strategic allocation by and large, you know that I have maybe 10 crore of investment. Out of 10 crore of investment, I'd like to probably have 2 crore as a safe haven. So this strategic allocation can also include emergency and planned expenditure, right? So you can keep tracking that. So for someone it can be 20%, for someone it can be 30%, for someone it can be 10%, right? Then let us move to tactical allocation. What is tactical allocation? It's a temporary allocation. Say for example, I sold a real estate property. I got some 2 crore rupees now. Now I need to invest in the market. Should I be dumping in the market? That event risk is always there, right? Maybe a COVID kind of event. Okay, if I'm a high risk taker, I can still do that. But if this is what we don't suggest, that we advise people to immediately park it in liquid and then do a systematic transfer plan, right? So from liquid, either you start gradually investing into a equity mutual fund or a hybrid mutual fund, or into a PMS or AF, whatever it is. So this is a tactical. So that means currently money is sitting in debt, but this money is actually meant to eventually move to equities, and you define whether you are going to probably move 10% for every 5% correction in the market or a 10% correction in the market. So you can also consider hybrid approach. Hybrid approach is what? Okay, I got about 2 crores now. Probably I'm going to invest about 50 lakh lump sum, and then balance amount I'm going to do it through STP, systematic transfer plan, right? We also discussed the concept of between mutual funds and a PMS. The fundamental difference is that a typical mutual fund can have about 50-60 stocks. Some mutual funds even have 150 stocks. A typical PMS has about anywhere between 20 to 30 stocks. That means a concentrated portfolio. So what is the benefit or risk of having a concentrated portfolio? You have BSE 500. BSE 500 or NSE 500 has 500 stocks, right? So when you are having an equity mutual fund portfolio, because each fund is investing about anywhere between 30 to 150 stocks, when you have a bunch of about 7 funds, possible that you have an indirect exposure of about 350 stocks, right? We've done the study and then we can present you the data. So with about 350 stocks, I'm having a very diversified portfolio. But coming back to a PMS, I'm having only 20-30 stocks. So what are the possibility? In a falling market, a PMS can tend to fall faster. But at the same time, in a rising market, if these 30 stocks are well positioned, PMSs can actually move faster. So the decision of whether or not to get into PMS will depend on if you are happy with a return of about 12 to 13% or 15. Equity mutual funds perhaps can do that. And if you want a portion of the portfolio to also create us further, then you can actually consider PMS. But if you have 50 lakhs to invest, never invest in a PMS, always go for mutual funds, right? AFs, alternative mutual funds. You must have heard about SEBI has mandated minimum threshold of 1 crore for AFs, and if you are a accredited investor, there are norms which we can talk about it, then you are qualified to invest in 25 lakh. Now let me tell you, so what am I calling the second bucket? I am calling the second bucket as a compounding bucket, right? So what I mean by compounding, we already discussed about compounding. If money is growing at 15%, right? So money should double every 5-year period. So in about 10-year period, money is becoming 4 times. In about 15-year period, money is actually becoming 8 times. So this is how compounding can happen. So what are the factors that can actually enable you to compound? We already discussed the choice between equity portfolio versus professionally managed portfolios, right? So simple, there are times I meet people who have been effectively managing their portfolio without actually creating much large loss-making portfolio. They've been consistently beating. My advice to them, beating the benchmarks. My advice to them, continue doing what you're doing because you have the expertise to manage it and you've been doing well, continue. But if your past experience is not so great, right, and if your portfolio has bad stocks, you're having hesitation in terms of booking loss, then you can always adopt some of these things. As to what is the choice, probably the time is too short for us to talk about it in the limited time. Then we'll probably have this discussion on one-on-one basis. So in my view, if you're by and large happy with about 15% kind of return, you don't have to go beyond this. But some of you might feel that I don't mind taking a risk of 10% on my portfolio. Then I'm actually targeting a return of maybe 20-25%. That's when you consider the other categories like unlisted or even private equity. So in my view, I think the allocation for something like this can be about 10%. That too only when you wish portion of the money to grow very fast, right? So possible that okay, this allocation can be about 30% here, 60% here, 10% here. When I present this model, some of them say that I don't want anything here. I will put 20% in the low risk bucket, probably 80% here. Somebody might say that all my planned expenditure, everything is taken care. I want my money to compound. I'd like to have 80% here. It's normal compounding. And then maybe 20% I don't mind taking risk here. So I think it is very important that you take a top-down approach of the portfolio. See what happens, okay, we are always doing the piecemeal job. We are buying that NFO, we are buying this sectoral fund, we are buying that stock. So wherein it happening, I think we are accumulating those investments which are not aligned, right? So when you do this approach, I think it will give you fair clarity as to how the portfolio should be, and then track your portfolio probably in this lens. When you do that, I think your portfolio will be more or less in control, right? So I think in the interest of time, I'm just skipping this. I think I'll just take only 2 minutes to talk about this. One, we spoke about retirement planning. Retirement planning is only portion of the financial planning, right? Then we also have other financial plans, other goals to achieve. We spoke about before. We need to buy property. We need to educate. We need to fund children education. We need to create emergency funds, right? We need to also have holiday. We need to also create a holiday fund, right? So we need to define. So the process, if I need to explain, you write down your goals, each of them. Some of them can also define charity as my goal. I need to create so much of charity. Timelines, okay. So I need probably I have 2 children, one of them 12, one of them 14. So I want to create this retirement fund by the time that the education fund by the time both of them turn 18. And what are the timeline that you've got, and what is the amount that you require, and then estimate the amount that is required, and analyze the current investment. Then mapping the investment against every goal. I think when we do this portfolio exercise, we take into account all your investments, and then on one side we look at all your goals, and then align those investments into each of the goals. That's an exercise very important. And when you do this exercise, then you'll know whether you have sufficient money, or whether your direction is going right, that you'll be able to achieve everything, or probably you need to realign your goals. Probably instead of 2 lakhs, possible that okay, I may not be able to achieve that. 2 lakhs is becoming too much. Then I need to reduce my expectation to 1,50,000 rupees, which is expected, and then work towards achieving that kind of goal. So we need to realign, restructure, and then allocate assets based on our growth and protection needs, and then review progress. I think review has to be done at least once in 6-month period. So this is the process that we follow. You will have clarity. When you do this exercise, you will have clarity. You understand how much each goal costs in the future terms, right? So you will be able to prioritize your goals, and then you will be able to also discipline, and then you have a better chance of achieving your financial goals. I think this is a quote by Howard Marks, who's a great fund manager with Oaktree for a long time. Experience is what you get when you didn't get what you wanted. See, if the last 5 years, starting from COVID. Okay, so anybody who started investing made money wherever they invested because the markets have rallied until September of 2024. Right? So put a SAP, you made money. Put lump sum, you made money. Right? Wherever you put the money, money has grown. Right? And that's when you never gain experience because everything is working out for you. So experience is what you get when actually things don't work out. I think it is a period since September, where markets have touched the peak, and then again we've seen the peak. But in the portfolio side, we've not seen many portfolios doing well. There are very few funds which have actually started doing well during this period. Very, very important for us to choose the right kind of investment, and we are willing to help you. Right? So we will open up for Q&A.
How to plan for rupees 2 crores in 10 years.
So let me use the calculator here. So you have 10 years time, and then you need to achieve 2 crores. There are two ways to do it. You can do lump sum approach, you can do SIP approach. So let us talk about how lump sum can be. Let me assume over the next 10-year period, markets will give moderate return of 12%. So generally, when we estimate, we always estimate moderate returns. I can also take 15%, but I prefer to take 12% return. Or the markets delivering 12% return over the last 7-year period. So let me calculate what is the amount that you need to require today to be able to have this goal. So I'm expecting 12% return, and then you have 10-year time, and then your future goal is 10 crore. So you need roughly about 3.2 crores today, 3.22 crores today to be able to achieve 2 crores. Actually, sorry. I think I've gone with reverse. Okay, let me just rework on that. I've taken the calculation for 10 crores. My apologies. So you have a 12% growth rate, and you have 10 years time, and then you want 2 crore to be achieved. So you require about 65 lakh rupees to be invested today, and when the money is growing at 12%, right, it will become 2 crore. So at the same time, same amount can be achieved through SAP also. So you require an SAP of almost 87,000 every month for the next 10-year period to get this 2 crore.
What are the avenues to generate a steady income of rupees 5 lakh per month?
See, we spoke about to generate cash flows. Number one choice is SWP, Systematic Withdrawal Plan. We've already explained why. Because it's going to, it is tax efficient. It gives you a fixed amount of 5 lakh rupees. It takes care of inflation, everything, all that we talk about. So the choice of whether you should go with direct mutual funds or a hybrid mutual funds will depend on your individual risk appetite. So number one option is SWP. Number two, if you have a rental income, you can consider that, and then otherwise, you can consider some of the pension plans. Some of the pension plans are very attractive, or some of the traditional plans from insurance side. So how much of pension plans you need to have, or how much of SWP you need to create, it all depends. Again, you can create maybe 70-80% through SWP, 20-30% revenue to happen from pension plan. You can also have rental income coming in. So I think, but by and large, I think these are the two things which are my favorite in terms of creating. So to create a 5 crore ka rental income, let me assume that you require 5 lakh ka rent income every month for the next 10-year period. I'm just doing the working, assuming that you require 5 lakh per month for the next. So let me assume that money is growing at 12%, and you require money for the next 10-year period, which is 120 month. So the amount that you require is, I'm just taking 5 as a number. So your initial investment has to be about 3 crore 48 lakh. If you have 3 crore 48 lakh rupees, you'll be able to create a 5 lakh, which is almost 60 lakh income. So this is how it's possible. The best options are SWP. Either you do it through equity mutual funds or a hybrid mutual funds, or a pension plans from some of these very interesting pension plans are there. We will be able to connect with you. Though we are not able to address all the queries, believe me, we will try to reach out to you one-on-one. Our team will reach out to you one-on-one and then personally talk to you and then address these issues.
What is a simple method for investing in mutual fund and equity shares?
See, objective is compounding. We already discussed about compounding, right? So in my experience, I've seen that, people who are managing direct equity portfolio are not able to compound. But you are among those 5% of the people who are able to do that. You need to follow those discipline in terms of getting rid of the bad stocks and then having limited number of stocks, and then follow that. I think following the sector, if you're a specialist, you can continue to do that. But if you don't have that skill set, then choose those mutual funds. You need not pick up more than 10 mutual funds. 10 mutual funds is the maximum number of mutual funds, and we will be able to handhold you in terms of choosing the right kind of instruments for meeting your exact goal, right? So equity mutual funds are the best class. Within that, flexi cap mutual funds are even better, right? So you also have categories like large and mid cap category. Large caps may not be a great idea unless you are a risk averse, right? So there are multiple varieties that we've got. We will be happy to sit with you personally and then understand your specific requirement and then talk to you about exact goal that suits you.
I want to get rupees 10 crore before 60. My current age is 46. Can you guide me?
So you have 14 years left. And what is the amount? 10 crore, right? So to get 10 crore, so let us assume 12% growth rate, and you have about 14 years to achieve this. And you want about 10 crore to get that. So you need about 2 crore 5 lakh as a current investment. So if you do that, if you do 2 crore 5 lakh rupees investment over the next 14-year period, it will become 10 crore. And then the best way to participate is, as I said, combination of good quality mutual funds and a PMS. So probably if there is a portfolio of 2 crore to be created today, right? So I would suggest that maybe 1.5 crore can get into mutual funds and then 50 lakh can get into good quality PMS. We will be happy to assist you on that.
How to retire and lead a rich life through mutual funds?
See, mutual funds are the most favorite. Okay, this is a very subject. I think there is no specific details. There is no definition of what is rich retired life. So everything helps. Okay, when you have numbers with you, right? So just like in the previous case, okay, the person who's asked this question has been very specific that I require 10 crore by 60, right? I'm sure, okay, he must have done some working here. So to address this question, it's difficult. I think if you can be more specific as to what exactly you want to achieve before your retirement, or you tell me that, okay, 5 lakh is what I require every month. Is that rich luxury life? Or you might define maybe 3 lakh per month can be a luxurious life. So then if you have the specific numbers, we will be able to actually work out and then tell you how is it possible to achieve this number.
Please share good diversification examples.
Perfect. So I'll show you. Let me share the screen once again. What we do is that we create some model portfolios. I'll showcase you some of the model portfolios. This is one category of model portfolios meant for equity investors, but don't want too much of risk. Meaning, okay, we avoid small cap exposure here, right? So here what we've done, we've created a list. So if you can see, we've created a portfolio of about 7 mutual fund schemes here. If you notice, some of them are multi-cap, large and mid-cap, again large and mid-cap, flexi-cap. There is only one mid-cap that you can see here, and then one multi-cap assets. So what is happening through 7 mutual fund schemes, right? You got an exposure of almost 331 stocks, right? This is software. Software tells us because each other fund invests in a number of stocks. So through 7 mutual fund schemes, you are getting. So most of the times, okay, what is the objective of investing into mutual funds? Now we've always got indexes invest, so you can go with ETFs. Our objective is that if BSE 500 is delivering about 12-13% kind of return, we want probably a good quality mutual funds to beat that return, right? So what are the chances of beating a BSE 500? Should we have more number of stocks than BSE 500, or should we have less number of stocks? Obviously, we should have less number of stocks, but good quality stocks, because BSE 500 will have some performers, will have some non-performers. So the chance of fund manager performing better increases if he is able to pick the performers. So let us assume that, okay, this is a very well diversified portfolio, but less than BSE 500. I think this is an ideal situation that we want. What is an investor that we want? We want probably a market risk, but a better return than the market, right? So 333 stocks is a very well diversified portfolio. So let me also show that top 20 stocks, generally when we manage our own portfolio, probably we can have a 20 stock portfolio, 30 stock portfolio. But here, because we are through 7 mutual funds, we are investing in 330 stocks, right? The top 3 is having only 12% exposure. That means, okay, if I put 1 crore in these 7 mutual funds, my almost 12 lakh rupees is invested into top 3. My 40 lakh is invested into top 20. That means it's a very well diversified portfolio. And let me also tell you that the bifurcation between large, mid and small, because there is a stability that we require, because in this particular portfolio, we don't want to carry too much of risk. So we've had higher exposure to large cap. So almost close to 60% to large cap, some amount to mid cap and some small cap, right? So this is how we create a balanced portfolio. Again, exposure to multiple sectors. Then we backtest this model. How the portfolios like this has performed the last maybe 5-6 years. We take 6 years because again you go back to 5 years, then you exactly start with the bottom. Starting with the bottom is not the right way. So when we are starting from October of 2029, you just invested prior to COVID, then portfolio is actually taken the beating at COVID. Markets have actually fallen by 38%, portfolio fell by about 35 odd percent. But you can see the green line eventually started performing better than the market, right? So if you can see the last 5 years, this portfolio of 7 stocks has delivered actually 22%. No guarantee that they will do it in future, but we are only looking at what they've done in the past. One is the return part of it. Last 5 years, 3 years, they've done it. Last 1 year, there is slight underperformance, but historically, they've done good, right? But let's also look at the risk parameters. What do we measure risk? We measure risk through volatility, which is standard deviation. If you can see this number, annual volatility, which is our portfolio is of 15.31% versus BSE 500 volatility is 17.54. So that means, okay, portfolio of these 7 stocks has delivered by higher return, but has achieved the same thing at a lower risk. That's what we want. So we want a diversified portfolio which carries a relatively low risk, probably has the potential to beat the benchmark, right? So these are the parameters that we look at. And obviously, we look at various parameters like Sharpe. There are various quantitative parameters that we look at, also qualitative, right? So there is something like up capture, down capture. In a moving up market, how the portfolio is done. In a falling market, how it's done. We also go back and then see what are the major market falls in the last 6 years, right? Starting from COVID, how much the portfolio fell, between what dates, and how long the portfolio took to recover its losses. So this talks about resilience of the portfolio. So every fall, every major fall in the last 6 years has been captured here. And the fall happened between what day to what day, by what measure, and how many days and by what date has the portfolio recovered its losses. I think this also talks about resilience of the portfolio. And finally, we move back to overlap. What do you mean by overlap? Ultimately, the same market, same number of stocks. Mutual funds also invest into same stocks. Possible that, okay, mutual funds invest into same level of stocks, right? So we don't want a situation that the 7 mutual funds that I'm investing into have similar stocks to a degree that is more than required. So what we do is that we compare what is the common stocks between each of the stocks. Say, for example, between Nippon India Multicap and Bandhan Core Equity, there is a 32% is equal, common stocks. We generally avoid if the ratio is going up beyond 40%. Then we will be happy to replace it with something else. So what we dynamically track on a continuous basis, if it is going beyond a point, then we'll consider shifting it, or if there is an underperformance, or if there is a change of fund manager, then we will be coming back to you and replacing with something else. So through overlap, say for example, Motilal Midcap has the least amount of overlap with anything else because it's a core midcap and rest of them are in the flexi kind of cap, right? So this is what we do it. And then finally, we also look at the past returns, fund managers, who's been managing it, how long the fund manager is managing it, what is the AUM of the fund. So it's not just diversification, it's about all the analytics that we do it before we start presenting a portfolio to you, right? I hope this addresses the question.
What is the percentage allocation on retirement investment between debt fund and stocks or mutual funds?
So there's no straight answer to this. This has to be worked on an individual level. It's possible that, okay, so somebody is having a high risk appetite and also the great amount of cushion. Say for example, the retirement corpus required is about 5 crore and the person is already sitting at 10 crore. So because there is already higher amount of money that is available, so in this case, okay, probably going conservative may not help. Okay, so in this case, because there is more than required amount that is available and the investor is also having high risk appetite, then we rather allow the money to probably be in complete equities rather than in debt. But the only flip side is that if the markets are falling, the investor need to brace himself with the higher amount of drawdown. If by and large investor says that, okay, I'm a high risk taker, I understand the risk, I'm okay with the risk appetite, then we rather choose equity mutual funds. So I think I can also tell you that there are cases where financially there is an appetite, but mindset is not there to take risk. Give an example. There is a gentleman that I met many years back. He used to work for a large hotel chain, 5-star hotel chain. We met him. He used to hold large amount of ESOP stocks. Right? He's a risk averse person. He used to, every time we met, I think he used to talk about, they used to live in Kashmir and then they're Kashmiri Pandits. One day they had to leave all the assets and then come back here with nothing on hand. So then he used to talk about that. So he's basically risk averse. What are the plans that we proposed? I think he was not okay with it. But eventually one day he himself came and met me and then asked me, I think last time, what are the plans that you showcased are interesting. I'd like to consider them. Then I asked him only one question. Are you okay seeing the portfolio falling down by about 20% at any point of time? He said no. Then I said, okay, don't come to this, because there is one thing, I think financially he's actually capable of handling the risk, but in terms of mindset, he's not okay seeing the portfolio eroding. Then he's better off being in fixed income. Though the fixed income erodes, I think because the mindset, okay, he doesn't have the risk appetite to handle the risk or ability to see the portfolio eroding, then he should not be an equity person, right? So as an equity person, I think the price that we pay for the compounding that we get is the volatility of the market, right? I think that is something that we always need to keep in mind. The exact ratio, what should be the ratio between debt and equity is a personal issue, which we cannot probably commonalize between everyone. So that is something that we need to discuss personally. So in case since you left the comment here, my team will speak to you personally, and then we'll try to figure out what is the ideal allocation for you.
I am planning an early retirement at 45 or 46 years old. I am 41 right now. Can you guide me?
So again, no further details are given. Let me tell you, I think I can talk about one case. When you retire early at 45, because you got only 4 years to retire now. But what you need to keep in mind is that, assuming that you live up to 85, you have 40 long years to fund yourself. First of all, we need to get the math right as to what is that the standard of living that you live, what kind of amount that you require to survive for 40 long year period without cash flow, right? So let me talk about one example here which matches this. There is a gentleman that I met in 2019, right? This happened after the 2018 market crash. He retired at the age of 40 from a reputed bank, foreign bank. So he started very well in his career and then reached a very top position. But for some reason, he's decided that he has to retire early, because those people who are continuing with the high pressure job, they're having some kind of health conditions, and for him, he prioritized health. And he also he's got sufficient money as ESOPs. He felt that that's good enough money. So he invested partial amount into real estate, partial amount into stocks, which he used to manage it. Everything is going well. So I think the time that I met him, he was about 63, right? So he managed comfortably between 40 and 63. But what has happened, for some reason, by 2018, he's taken heavy exposure into small caps, right? Heavy exposure, that to leverage into small caps. And markets have actually collapsed. Small and mid caps have actually collapsed. And then he lost major portion of his savings. Thankfully, he's got real estate to bank upon. But what I'm saying is that, again, I cannot give you subject to answer, because all that I can tell you is that you need to fund 40 long years of life, right? Which will work out to large sum amount of money. So we will be happy to call you, understand those specific details as to what is the monthly income that you expect to receive. And it's not just the retirement. I think there are other requirements also. And then we'll be able to tell you whether you are in a position to actually retire or not. There are two cases, okay? One, again, a hotelier wanted to retire. We've done the same working and told him that probably he cannot retire until 50. And there's one more case. There's a couple in Delhi that where we worked. I think they're already in their 50s. They were not contemplating retirement, but once we've done the working, they felt okay, good to go ahead and retire. They've actually taken a call on early retirement. So everything depends on the math. The math will depend on the details that you provide. So we will be able to just connect with you separately and then collect those details, and then exactly talk to you about whether you are in a position to retire or not. I think it looks like there is no questions as of now. It was wonderful connecting with you all, and then I hope, sincerely hope, the last 1.5 hours that we spent has helped you in gaining some clarity and got some insights into the concept of retirement planning and financial planning. But nevertheless, as I told you earlier, it's not just the education. We are willing to handhold you and guide you through your investment process, right? So there's a small QR code that you can see on the screen. Just in case if you want us to call back for any further inquiry or details, you can just type in your details, okay, which will capture only basic details, your name, location. So then we'll be happy to call you back, and then we can have a conversation to address your specific requirement. So thanks all, thanks for joining, and then it was wonderful interacting with you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.